The 50-30-20 rule is not complicated. 50% of your income goes to needs, 30% to wants, 20% to savings. You have known this for years. Your bank account has not noticed. The rule is not broken. The rule is fine. The problem is that the rule assumes you are a rational agent who categorizes spending accurately, feels the same about every dollar, and makes consistent decisions across time. You are not that person. Nobody is. Why budgets fail psychologically. So let's talk about what actually happens inside your brain when you try to follow a budget. Not why budgets fail in theory, why this specific one fails for you, specifically every month. The first problem is that needs and wants are not fixed categories. They are negotiable mental labels that shift depending on your mood, your social context, and how you frame the question to yourself. A gym membership is a want when you are budgeting. It becomes a need when you are about to cancel it. Netflix started as a want. Now, canceling it feels like losing something essential. Your morning coffee out is technically a want, but removing it from your routine feels like a meaningful reduction in quality of life. The category, the expense, belongs to changes based on how attached you have become to it, not based on any objective measure of necessity. The second problem is mental accounting. A dollar is a dollar, regardless of where it comes from. Psychologically, money feels completely different depending on its source. A tax refund feels like found money. A bonus feels more spendable than regular salary. Winnings feel less real than earned income. The math is identical. The feeling is completely different. This is why bonuses rarely make it to savings. They arrive in a different mental account than regular income. They feel like extra money that exists outside the normal budget. So they get spent on things you would never buy with your regular paycheck, even when the math is identical. The mental bucket determines the behavior, not the dollar amount. The third problem is that budgets rely on willpower, and willpower is a finite resource that depletes throughout the day. The decisions you make about spending at 9 in the morning are made with a different cognitive resource level than the ones you make at 9 at night after a full day of decisions, stress, and mental effort. The version of you who committed to the budget this morning is genuinely different from the version making spending decisions tonight. Not morally weaker, neurologically different. Decision fatigue is real and measurable, and it affects financial choices the same way it affects every other kind of decision. The fourth problem is social spending. A significant portion of most people's discretionary spending happens in social contexts where saying no has a social cost. Splitting a bill at a restaurant, going to the birthday dinner, joining the work lunch. These expenses are technically wants, but declining them carries a real social price that the 50-30-20 rule does not account for. Your budget has a line for dining out. It does not have a line for the social pressure of being the only person at the table who ordered water. It does not account for the calculation you make between spending money you do not have and damaging a relationship you do care about. The birthday dinner you did not plan for. The work happy hour that happens every Friday. The fifth problem is irregular expenses. Your budget is built around monthly recurring costs. But life operates on an irregular schedule. Car repairs, medical bills, annual subscriptions, travel for a friend's wedding. These are not surprises. They are entirely predictable in category, entirely unpredictable in timing, and they reliably destroy monthly budgets. The standard advice is to build an emergency fund. Good advice. The problem is that the 50-30-20 rule allocates the savings percentage toward retirement or investment goals. If an irregular expense hits before that fund exists, it comes out of the wants budget, then the needs budget, then the credit card. The car repair was predictable in category. The timing just was not. The sixth problem is that the wants category expands automatically with income. When you earn more, the baseline of what counts as a normal want shifts upward. The 30% stays at 30% of a higher number, but the actual spending in that category grows. This is lifestyle inflation operating inside the budget it sits. You are technically following the rule at every income level. You are also spending significantly more on wants at each income level than the previous one. The percentage is the same, the behavior is different. The rule does not flag this as a problem because percentages do not capture absolute spending growth. A rule based on percentages is blind to scale. The seventh problem is tracking. The 50-30-20 rule requires you to know where your money is actually going. Most people significantly underestimate their spending in every discretionary category. Research consistently shows that people recall their dining out spending at roughly 60 to 70% of what bank records show it actually was. Spending on experiences feels less significant in retrospect than spending on objects because the experience is gone and the emotional charge has faded. Your brain does not store small frequent purchases with the same weight as large infrequent ones. So when you try to recall what you spent this month, you are working with a systematically distorted memory. Let's look at what the 20% savings rule actually produces at different income levels. At $40,000 a year, 20% is $8,000 annually. At $80,000, it is $16,000. At $30,000, it is $6,000. The same percentage produces very different financial trajectories. The rule does not see this. It only sees the percentage. Someone earning $30,000 saving 20% has a very different financial trajectory than someone earning $100,000 saving 20%. Not just in absolute terms, but in terms of what that savings can realistically accomplish in a human lifetime. A percentage rule is blind to this. It treats both situations as equivalent. They are not. What actually works? So if the 50-30-20 rule has all these problems, why does every financial resource still recommend it? Because despite its limitations, it is significantly better than having no framework at all. The issue is not the rule. It is treating the rule as a complete solution rather than a starting framework that needs modification for real humans. The most effective modification is to automate the savings and investment portion before the money enters your spending account. Pay yourself first. The behavioral reason it works is that it removes the need for willpower from the equation. You cannot spend money that is not in your account. The lifestyle that follows adapts to what remains. The second modification is sinking funds for irregular expenses. Instead of being surprised by car maintenance or annual subscriptions, you calculate the annual cost of each predictable irregular expense and divide it by 12. That monthly amount goes into a separate account that exists specifically for that category. The expense stops being a surprise. The third modification is accepting that you will not track every dollar with equal precision. Instead of trying to monitor every category perfectly and failing, pick the 2 or 3 categories where you historically overspend and focus all your tracking energy there. Everything else gets a rough allocation and a monthly check. Imperfect tracking that actually happens beats perfect tracking that never gets done. The fourth modification is creating an explicit social spending category separate from dining out or entertainment. This is money you allocate specifically for the spending that happens in social contexts where saying no has a real cost. When that category is funded, you can participate without guilt. When it runs out, you have a concrete number to reference rather than an internal negotiation every time. A 50% savings rate that you sustain for 3 months, then abandon is less valuable than a 15% savings rate you maintain for 15 years. Perfection in financial systems does not exist. Consistency does. And consistency requires a system that accounts for your actual psychological limitations. Not an idealized version of yourself that does not get tired, does not face social pressure, and does not have irregular expenses. The month where you completely abandon the budget is not the problem. The problem is treating that month as evidence that the system does not work, and therefore stopping. Every budget system fails in some months. The question is whether you return to it or whether you let one failed month become permanent. Should you follow the 50-30-20 rule? Yes, with the caveat that following it means adapting it to account for your actual income, your actual irregular expenses, your actual social spending patterns, and your actual psychological limitations, rather than a version of yourself that makes perfectly rational financial decisions every day. The rule is the starting point. You are the variable it did not account for. The problem was never the rule. The problem is that financial rules are designed for rational agents. You are not a rational agent. You are a human being with decision fatigue, social obligations, inconsistent self-perception, and a brain that treats identical dollars differently based on where they came from. Any financial rule that does not account for that is incomplete, including this one. The budgeting system you actually use, imperfectly, inconsistently, with modifications that technically violate the original rule, is worth more than the perfect system you design and abandon in the third month. That is not permission to not try. It is permission to keep going after you fail, because you will fail. That is also not the problem. 7 problems, 4 fixes, 1 rule that was never complete to begin with. The 50-30-20 rule is correct as a starting point. What makes it work or not work is whether you use it as a rigid prescription or as a flexible framework that you actually engage with consistently, adjust when life does not fit the percentages, and return to after the months where you abandon it completely. The most useful version of the 50-30-20 rule is the one you modify to fit your actual life, fail occasionally, and return to without treating the failure as evidence that budgeting does not work. The failure is part of the system. The return is the system working. Here is the final thing worth saying about the 50-30-20 rule. The spending will always happen. The question is whether it happens with a framework or without one. An imperfect framework produces better outcomes than no framework, even when it fails sometimes. That is the case for budgeting. Not that it will be perfect, that it will be better than the alternative. If you have a budget that you are not currently following, the first step is not redesigning it. It is opening it and filling it in for this month. The version that is never budgeted needs to build the system. The version that is budgeted before just needs to open the document. That is a much smaller action than it feels like from the outside of a month you already know was imperfect.
Fine. Subscribe. It won't help, but it might make you slightly less easy to manipulate.